I want you to imagine just walking onto the floor of the American Stock Exchange in 1983.
Oh, man. Complete chaos.
Absolute chaos. I mean,
Yeah.
you are just surrounded by hundreds of guys in these brightly colored jackets, and they're physically shoving each other,
Right.
screaming over the din, frantically passing these little physical paper slips back and forth, literally just to execute a single stock trade.
It's hard to even picture now.
It is. The air is thick with sweat and adrenaline and just, complete inefficiency.
Yeah.
And then this Hungarian refugee named Thomas Petersi walks right into the middle of this absolute mayhem.
Yeah, he's not holding paper slips.
No, not at all. He is holding this boxy, hand-built computer tablet, and it's got a wire dangling out of it.
Like an iPad from the Stone Age?
Basically, yeah. And he takes that wire and he plugs it directly into the data terminal on the wall.
Wow.
And the exact second that connection goes live, he effectively triggers the extinction of the human trader.
The visual of that moment is just incredible, honestly, because the establishment there, they were absolutely terrified of what he was holding.
Oh, they hated it.
They did. Because that little hand-built tablet, it was calculating pricing algorithms.
Yeah.
Way faster than any human brain in the pit could process.
Right.
And those floor traders, they realized almost instantly that they were looking at their own obsolescence.
And their reaction to that existential threat was, well, it was hilarious.
Yeah, they didn't take it well.
No. They didn't try to innovate. They didn't try to build their own tech. They just tried to regulate the tablet out of existence.
Typical legacy reaction.
Exactly. So when they realized they couldn't ban it completely, they imposed these absurd physical restrictions on him.
Wait, what did they do?
They actually mandated that Peter Beffy take his tablets back to his shop and physically round off the sharp corners.
You're kidding?
I'm completely serious. The floor traders complained that the boxy edges were, quote unquote, hurting them when they bumped into each other in the crowd.
That is amazing. They were literally trying to round the corners on the meteor that was about to wipe out their entire industry.
That is the perfect way to phrase it. And so you fast forward roughly 40 years, and the guy holding that tablet has built a $155 billion financial machine.
Thomas Peterfy's company, Interactive Brokers.
Yes, ticker symbol IBKR on the NASDAQ. Today, they process more than 4 million trades a day.
Jeez.
They hold nearly $800 billion in customer equity. And yet, it remains arguably the quietest, least understood, and honestly, most incredibly boring brokerage firm on Wall Street.
It really is invisible plumbing for most people.
Right. But look, if you are managing your own portfolio or, if you work anywhere in the financial sector, you interact with the legacy of that tablet every single day.
Whether you know it or not.
Exactly. So today we are tearing apart Interactive Brokers Group. We've gathered a massive stack of source material, and we're anchoring this deep dive with a Q1 2026 data spine.
So we have the freshest numbers.
We do. And our mission today is to completely deconstruct this business. I'm going to be bringing the analytical lens. We're going to dive deep into the revenue mix, the unit economics, which border on the impossible, by the way.
They really do. It's wild.
And we'll get into the specific mechanics of their margin lending and their overall capital allocation.
And I'll play the role of the skeptic today, because someone has to.
Please do.
My job is to stress test this bull case you're building. I'll be looking at the competitive dynamics, especially the threat from those zero-commission retail giants.
Like the Robin Hoods of the world.
Exactly. And I really want to highlight the structural, macroeconomic, and governance risks that are kind of baked into this company. Because, look, when a business looks this perfect on a spreadsheet, there is always a catch.
There is always a catch. But before we get to the spreadsheets and the 77% pre-tax margins.
Still can't get over that number.
I know. But before that, we need to fundamentally reframe how we think about the stock market. Because most people view the market as a place where you just go and buy companies.
Right, like a grocery store.
Yeah, but structurally, it is much closer to an incredibly inefficient global shipping port.
Okay, I like this. Walk me through the mechanics of that port.
So in a legacy shipping port, right, if you want to move a cargo box from a ship to a truck, you can't just walk up and do it yourself.
They wouldn't let you.
No.
Yeah.
You have to hire this whole network of middlemen. You hire a guy to lift the box, another guy to carry it 10 feet across the dock, and a third guy to actually load it onto the truck.
And everyone wants a cut.
Everyone wants a cut. Every single one of those humans charges a fee, and every time the box changes hands, it introduces a delay and the risk of, dropping the box.
Right.
The global stock market operated exactly like this for 150 years.
Literally an exclusive club.
Yeah, it was. The general public was not allowed inside the exchange. If you wanted to buy a stock, you had to hire licensed intermediaries to walk your order across the floor.
And the most insidious part wasn't just the flat fee they charged you for the labor.
Mhm.
It was the cut they took out of the cargo itself.
Exactly. And this is where we have to talk about the bid-ask spread.
This is the crucial mechanism of the pre-1990s market that Peter Fay really exploited.
Hmm.
Because back then, stocks weren't traded in decimals like they are today.
Right, they used fractions.
Yes, specifically eighths and sixteenths of a dollar.
Okay, so an eighth of a dollar is 12.5 cents.
Right. So imagine the true intrinsic value of a stock was exactly $10. The market maker on the floor, the guy handling the transaction, he would quote a bid of $9.87
Okay.
and an ask of $10.12.
So if you wanted to buy, you had to pay the higher price.
Yes.
Yeah.
And if you wanted to sell, you received the lower price. And those floor traders, they pocketed that massive 25-cent difference on every single transaction.
Assuming zero actual risk.
Zero risk. It was just a legally mandated toll booth.
And if you really want to feel the texture of how predatory that shipping port was, I mean, you just look at Jordan Belfort's The Wolf of Wall Street.
Oh, classic.
And I'm talking about the original book here, not the Scorsese movie.
Right, the movie's all parties and excess.
Yeah, the movie distracts you with all that, but the book is actually this granular, step-by-step manual on market mechanic.
Belfort outlines the grift perfectly in that book. He explains how these brokerage firms would act as both the broker, representing the client.
Specifically representing them.
Right. And they'd also act as the dealer, meaning they held the inventory of the stock themselves.
Yeah.
So they would aggressively push these obscure pink sheet stocks to retail clients over the phone. And because the firm controlled both the order flow and the inventory, they could artificially widen that bid-ask spread to 50 cents, or even a full dollar.
A full dollar.
Yeah. The client thought they were just making a standard investment. But the absolute moment the trade executed, the brokerage had already extracted like 10% of the principal, just in the spread alone.
Because the spread was the entire business model of Wall Street.
Exactly.
The difference between what the customer thought they paid and the actual price the asset traded for, that was the profit margin.
Which brings us right back to the core realization that built Interactive Brokers.
Peter Fellefee looking at the pit.
Right. When Thomas Peter Felley looked at those guys screaming in the pit, taking 25 cents on every share, his insight was just utterly ruthless.
Which was what?
He realized none of these humans add a single piece of actual information to the pricing of this asset.
They are pure cost.
Pure cost. They introduce delay, they make mathematical errors on those paper slips, and they extract these massive, massive rents.
So he looked at the shipping port and realized, why didn't I just build an automated conveyor belt?
That's exactly it.
A computer program could read the bid, calculate the fair value based on correlated assets, send the order, and confirm the execution in milliseconds.
No screaming, no paper slips.
And no 12.5-cent toll booth. By 1987, his firm, which was called Timber Hill at the time, had built the first fully automated algorithmic trading system that could interface directly with an exchange.
Without a single human in the loop.
None. And this eventually evolved into Interactive Brokers by 1993, and the pitch back then was incredibly radical.
Oh, totally unheard of.
Peter Bersafi basically said, look, you can log into our platform and you can route your orders directly into the exchange's matching engine through our proprietary high-speed pipes.
Bypassing the brokers entirely.
Exactly. We don't employ any floor traders.
Yeah.
We don't charge huge markups. We charge a tiny, completely transparent commission, and we give you the raw, unvarnished market execution.
And that pitch, it really exposed the great structural truth of the whole financial industry.
Which is
That brokerage was never actually about financial advice. It was never about white glove relationship management. It is, and always has been, a logistics business in disguise.
a logistics business. That is the perfect way to look at it. And it's a logistics business where order routing is just a commodity.
Whoever can move the data packet from the customer's keyboard to the matching engine the fastest and at the absolute lowest marginal cost is eventually going to win all the volume.
Okay, before we dig into the modern margins of that logistics machine, we should probably quickly map out the corporate structure that houses it,
Oh, yeah. The structure's wild.
because it gets incredibly complicated when we discuss the risks later on. So, for everyone listening, there are two distinct entities you have to keep straight in your head.
Right.
There is IBG Inc., which is the publicly traded holding company under the ticker IBKR.
The stock you can buy.
Exactly. And then there is IBG LLC, which is the actual private operating broker-dealer. That's the entity that holds the licenses and the technology.
And you really need to keep that dual structure in mind, because the relationship between the public ticker and the private operating company, that is the source of the biggest bear argument against the stock.
We will definitely stress test that later. But, okay, if we accept the premise that order routing is a logistics commodity and that Interactive Brokers won by offering the lowest cost, we have to look at the competitive landscape today.
Let's do it.
Because in 2013, Robinhood launched, and they completely upended the retail brokerage industry by pricing that commodity at zero.
The free trade era.
They offered free trades, and eventually Schwab, Fidelity, and E-Trade, they were all forced to follow suit. So the question is, if the entire industry went to zero, how did Interactive Brokers survive while continuing to charge explicit commissions?
And to answer that, we have to look at the plumbing of modern market structure. Because this zero commission revolution, it is a total mirage.
A marketing gimmick.
It's a brilliant piece of marketing that obscures a massive hidden tax. Robinhood makes billions of dollars precisely because the trades are not free.
Okay, let's break down the mechanics of payment for order flow, or PFOF.
Yeah, PFOF. So when you open a zero commission app, right, and you hit buy on 100 shares of Apple,
Yeah,
that app does not route your order to the NASDAQ.
never.
They bundle your order with thousands of others, and they sell that bundle to a high-frequency trading firm, a massive market maker like Citadel Securities or Virtu.
Okay.
And the market maker pays the app a fee for the exclusive right to execute those trades.
Right. And looking at our sources, in 2020, which was the height of the retail trading boom, payment for order flow accounted for roughly 72% of Robinhood's entire revenue.
Wow.
72%. They aren't really a broker. They are essentially a lead generation service for high-frequency traders.
But you have to ask, why would Citadel pay hundreds of millions of dollars for the right to execute retail orders?
Well, because retail order flow is dumb flow. Right.
Exactly. Retail traders aren't executing massive market-moving block trades based on proprietary algorithms. They're just buying small amounts of stock at random times.
Usually based on a tweet.
Right. So market makers want to trade against this flow because they can capture the spread without the risk of getting run over by a massive institutional buyer.
Let's put specific numbers to that latency arbitrage. Say you want to buy a share, and the absolute best offered price across all public exchanges is exactly $100.
Okay.
The high-frequency firm receives your order from the app, they internalize it, and they sell you the share out of their own inventory for $100 and 1 penny.
So they pocket a single penny on the spread.
Exactly. Now, 1 penny sounds completely insignificant.
Who cares about a penny, right?
Right. But if you are buying 500 shares, that 1 penny just cost you $5 in hidden slippage.
Right.
Now multiply that by the millions of trades executed every single day. It represents this massive river of capital flowing directly from retail accounts into the balance sheets of a handful of market makers.
It's incredible. The user sees a banner on their phone that says $0 commission and assumes they got a free trade. They are completely unaware they just paid $5 in invisible spread degradation.
And this isn't just a theoretical concern, by the way. Between 2016 and 2019, the SEC investigated these exact routing practices.
Oh, yeah. Fine.
Yeah. They discovered that Robinhood was specifically routing orders to the market makers that paid them the highest kickbacks.
Not the ones getting the best price for the user.
Exactly. They completely ignored whether that market maker offered the customer the best price. And the SEC calculated that these practices cost the customers an average of about $15 in worse execution prices per 500-share order.
Compared to brokerages that didn't sell order flow.
Right. And the SEC ultimately handed down a $65 million fine.
So contrast that entire ecosystem with how Interactive Brokers built its flagship platform, IBKR Pro.
Completely different philosophy.
Completely. They structurally refuse to accept payment for order flow. They view it as fundamentally misaligned with the client's best interest. Instead, they built a proprietary piece of technology called smart order routing.
And I want to explain how this smart routing physically operates because it's fascinating.
Go for it.
So the U.S. equity market is incredibly fragmented today. You don't just have the New York Stock Exchange and the NASDAQ anymore.
No, there are so many venues.
There are dozens of exchanges, alternative trading systems, and these things called dark pools,
Right, dark pools.
which are essentially private exchanges where massive institutions trade huge blocks of stock without displaying their orders to the public.
Because if they displayed them, the market would move against them before the trade even executes.
Exactly. So when you hit buy on IBKR Pro, their smart router instantly scans all of these venues, the lit exchanges and the dark pools in microseconds.
Microsoft.
Yeah. And it doesn't just look for a single block of shares. It might actually split your order into 5 different pieces and route them simultaneously to 5 different venues just to capture hidden liquidity at the absolute best possible fraction of a cent.
And because they don't sell the order to Citadel, the customer gets the actual genuine market price.
Yes. And for providing that uncompromised logistics pipe, Interactive Brokers charges a tiny, completely explicit commission, usually half a penny to a penny per share.
So we arrive at the critical question for the competitive dynamics of this whole industry.
Hit me.
If the massive consumer brands like Schwab and Fidelity capitulated to Robinhood and dropped their commissions to zero,
Yeah.
why is Interactive Brokers still seeing record account growth while openly charging a fee?
Because serious money knows how to do math.
That's it.
If you are a professional trader or a hedge fund moving significant volume, paying a transparent $2 commission to get an execution that is $15 better on the spread is, it's the easiest mathematical decision in the world. The free trade is mathematically the most expensive way to access the market.
And this creates a massive demographic chasm between the platforms. If you look at the source materials we have, they provide an average account size metric that completely shatters the idea that Robinhood and Interactive Brokers are even in the same business.
Oh, the numbers are wild. So Robinhood captured the cultural zeitgeist, right? They gamified the interface. They brought in the weekend meme stock traders.
The Dogecoin crack.
Exactly. They dominate the swipe and tap dopamine demographic. And as a result, the average account balance on Robinhood is roughly $5,000.
Okay.
The average account balance on Interactive Brokers is $166,000.
Wow. That is a 33x difference.
33 times larger. They aren't even competing for the same dollar. Interactive Brokers is the undisputed home of the clever money.
We're talking about highly active professional traders, registered investment advisors, family offices.
And crucially, emerging hedge funds. Interactive Brokers is routinely ranked as the #1 prime broker for hedge funds with under $50 million in assets.
And securing those emerging hedge funds is an incredible structural advantage.
Why is that so sticky?
Because if you land a fund when they have, say, $20 million, and they compound their way to $1 billion, they don't leave.
They're locked in.
Completely. Their proprietary trading algorithms are hard-coded into your API. Their complex, multi-currency reporting structures are built around your ledger. You capture them early, and you just ride their asset growth for decades.
Which brings us to the Q1 2026 data spine. And honestly, this is the single most surprising revelation about this company.
The revenue mix.
The revenue mix, because we just established that explicit commissions are tiny, right? And they completely refuse to sell order flow.
Right.
So where on earth does a $155 billion valuation come from? If you ask most people how a brokerage makes money, they say trading fees. But let's look at the actual Q1 revenue mix. Out of $1.669 billion in total net revenue, only 37%, about $613 million, came from commissions.
Okay, so where's the rest of the revenue being generated?
54% of their revenue. A staggering $904 million in a single quarter came from net interest income.
Wait, more than half of their entire business model is just the spread on interest rates?
Yes, more than half.
Quick break. This show is built on the fundamental research of Yehonatan, our lead analyst and founder. Want his tools? Click the Substack link below to get 3 free resources for this company. The full deep dive PDF, an interactive valuation model to test your own growth and discount rate scenarios, and a 20-year financial spreadsheet, all completely free. Now back to the numbers.
To understand this company, you have to understand the 3 distinct prongs of this net interest income engine. It is just an absolute masterclass in financial engineering.
Let's break it down.
Okay, let's start with the first prong, customer cash balances. Right now, Interactive Brokers is sitting on roughly $169 billion in customer cash.
Now, to be clear to the listener, this isn't money invested in stocks or bonds.
You know.
This is just idle cash sitting in accounts. Maybe they're
Oh,
waiting for a trade, or it's cash generated from a recent dividend payout.
exactly. Now, Interactive Brokers takes that massive $169 billion pool and they invest it in ultra-safe, highly liquid instruments.
Like short-duration U.S. Treasury bills.
Right, which right now might yield around 5%. And to be fair to their customers, IBKR does share some of that yield. They currently pay roughly 3.8% on idle U.S. dollar balances.
Okay, so they capture the 1.2% arbitrage spread between the Treasury yield and what they pay the customer.
Yeah.
That's good money.
It is, but it is much more lucrative than that because there is a massive structural asymmetry in how they apply that 3.8% payout.
Oh, right, the threshold.
Yes. Interactive Brokers only pays interest on balances above $10,000.
Ah.
So if a retail customer has $9,000 sitting in cash, Interactive Brokers pays them absolutely zero.
Meaning, Interact Brokers is taking that $9,000, investing it in treasuries at 5%, and keeping 100% of the yield as pure profit. And when you aggregate all those sub-$10,000 balances across millions of global accounts, I mean, you're talking about billions of dollars of free funding.
It is essentially risk-free revenue generated simply by providing the digital vault.
That's wild.
And that is only prong one.
Okay, what's prong two?
Prong two is margin loans.
Ah, margin lending. This is where their lowest cost provider strategy really shines.
So if a hedge fund wants to buy $10 million worth of an index, but they only want to deploy $5 million of their own capital.
Right, they use leverage.
Exactly. They borrow the other $5 million from the broker using their existing portfolio as collateral. Now, because Peter Heavy treats low prices as a weapon, Interactive Brokers offers the absolute lowest margin rates in the industry. They charge institutional clients around 5 to 6%.
Which is incredible, because if you walk into a legacy retail broker, like a Schwab or a Fidelity, and ask for a margin loan, you could easily be quoted 11 or 12%.
Exactly. And for a professional firm running complex arbitrage strategies, a 12% hurdle rate just destroys their alpha. It's unworkable.
Right.
So Interactive Brokers uses those 5% rates as a massive customer acquisition magnet. It just pulls the institutional flow away from the legacy prime brokers.
And it clearly works.
Oh, it works beautifully.
Uh-huh.
Their margin loan book grew 35% year over year, hitting $86 billion. Earning a spread on $86 billion of highly over-collateralized loans is the second massive pillar of this interest engine.
Okay, so let's complete the triad. What is the third prong?
The third prong is securities lending, and this involves the granular mechanics of short selling.
Let's explain this simply.
Okay. If a hedge fund wants to bet that a stock is going down, they have to short it. But you can't sell a share you don't possess.
Yeah.
You have to locate someone who already owns the share, borrow it from them, sell it into the market, and then hopefully buy it back cheaper later to return it.
And Interactive Brokers acts as the central clearinghouse for this entire process.
There are the ultimate toll booth.
Yeah.
IBKR holds hundreds of billions of dollars in stock on behalf of their long-term investors. These investors are just sitting on their Apple or Tesla shares for years.
You do nothing with them.
Right. So when the short-selling hedge fund comes to IBKR looking to borrow 10,000 shares of Tesla, IBKR seamlessly borrows those shares from the long-term holder. And they pay the long-term holder a small yield, let's say 1% for the privilege.
Which the long-term holder is thrilled about, because an asset that was producing nothing is suddenly generating passive income.
Exactly. Then IBKR turns around and lends those shares to the short seller, but they charge them 4%.
Nice.
IBKR pockets the 3% spread every single day that the short position remains open, and they assume virtually no risk because the short seller has to post cash collateral.
Now, that 3% spread is on a highly liquid, large-cap stock.
Right.
The economics get totally wild when you look at hard-to-borrow securities.
Oh, definitely. During a meme stock frenzy, or, when a heavily indebted biotech company is facing bankruptcy,
Everyone wants to short the stock.
everyone wants to short it, but nobody wants to lend it. The demand skyrockets while the supply just evaporates.
And in those scenarios, the borrowing fee doesn't sit at 4%.
No.
It blows out to 20, 30, sometimes 50% annualized. And Interactive Brokers collects their massive cut of that fee simply for connecting the two sides of their own ledger.
Right. So if you aggregate the cash sweep arbitrage, the margin lending spread, and the securities lending toll booth, I mean, it raises a very serious structural question.
Are they even a technology company anymore?
Exactly. Or are they just a highly efficient, digitally native bank disguised as a trading app?
Look, I think the numbers make it undeniable. They are a bank. Every single new account, every integration with a new financial advisor is fundamentally just a funnel.
Just bringing in cash.
It brings in idle cash to deploy at a spread, and it brings in margin demand to lend against at a spread. The logistics software is really just the lure to get the assets in the door.
Which perfectly explains the massive earnings acceleration over the last few years.
Macro environment.
Yeah.
Yeah.
When the Federal Reserve aggressively hiked interest rates from near 0 to 5% to combat inflation, Interactive Brokers was the ultimate beneficiary. Every single one of those spreads widened simultaneously without the company having to change a single line of code.
Now, the interest engine explains the top-line revenue.
Mm-hmm.
But the valuation, the reason the market prices them at a premium multiple is driven by what happens to that revenue when it hits the income statement.
Yes.
We have to talk about the unit economics, because
Yeah.
this is where the business becomes practically invincible. The Q1 pre-tax margin was 77%.
Okay, I have to emphasize this for you listening. 77%.
It's absurd.
I have analyzed hundreds of financial models across every sector of the economy. A 77% pre-tax margin is almost physically impossible for a mature infrastructure company.
Right.
It is higher than Visa's operating margins. It is vastly superior to the median enterprise software company in the S&P 500, and it is roughly double the margin that a prestigious legacy firm like Morgan Stanley achieves in its wealth management division.
To understand how a 77% margin exists in the real world, we have to look at what Interactive Brokers does not spend money on.
Yes.
We have to examine their capital expenditures, or CapEx. Let's run a comparison against some of the businesses we've covered in previous deep dives, just to illustrate the concept of operating leverage.
Okay, perfect.
Let's take Netflix.
All right, Netflix. They have an incredibly dominant consumer platform, but their moat has to be constantly rebuilt.
Every single year.
Right. To prevent their subscribers from churning, Netflix has to spend roughly $18 billion every single year producing new content. If they stop pouring billions into new shows, the library stagnates and the revenue collapses.
Or look at a premium physical business like Chipotle.
Great example.
Our sources indicate Chipotle spends between $593 million and $683 million a year on CapEx.
Huge numbers.
If Chipotle wants to generate an additional $3 million in top-line revenue, they can't just flip a switch.
No.
They had to scout a physical location. They have to sign a long-term commercial lease, spend over $1 million pouring concrete, installing industrial HVAC systems and grills, hiring a management team, and stocking the coolers. Every new dollar of revenue is heavily gated by physical friction.
Okay, so what does the CapEx look like for Interactive Brokers? Let's look at the scale. They process nearly $800 billion in customer equity. They execute over 4 million complex financial transactions daily across 200 different countries. And their total annual capital expenditure is between $50 and $80 million.
On a business generating over $6 billion in net revenue, they were spending around 1% on CapEx. That is staggering.
It is the ultimate expression of software-driven operating leverage. And the reason their CapEx is a rounding error is because of how Thomas Peterson engineered the company decades ago.
He built it to scale.
Right. Look at massive legacy banks like JP Morgan or Charles Schwab. When they want to grow, they often just acquire other brokerages.
Right, they buy out the competition.
And when they do that, they inherit massive amounts of tech debt. They end up with 5 different legacy accounting systems, 3 different risk management databases.
It's a mess.
It's a complete mess. And they have to employ thousands of back-office humans just to manually reconcile the spreadsheets every night.
Whereas Peterson built the Interactive Brokers tech stack completely in-house. It is a single, unified, globally integrated code base.
Exactly. The matching engine is built. The complex API integrations with 160 international stock exchanges, they're already wired. The algorithmic risk management protocols are running automatically.
Right.
If Interactive Brokers wants to onboard a new $500 million hedge fund, or if they want to process the next $1 trillion in customer equity, They do not need to build a new factory or hire 5,000 back office workers.
They essentially just need to provision a few more server racks in a data center and pay for slightly more broadband capacity.
The marginal cost of adding the next $1 million of revenue is virtually zero.
Which means every single incremental dollar that comes in drops almost perfectly intact straight to the bottom line. That is how you arrive at a 77% margin. The software scales infinitely. The costs remain flat.
And there is a secondary benefit to this low-cost structure that management teams rarely highlight, which is the absence of the dilution tax.
Ooh, this is critical for long-term investors.
Yes.
Because a lot of retail investors look at high-growth software companies. They see revenue growing at 30% a year, and they blindly buy the stock.
Yep.
But they don't realize the company is funding that growth by constantly issuing new shares to pay for acquisitions or, paying their engineers massive stock-based compensation packages.
Right. Printing stock.
Every time the company issues a new share, your piece of the pie gets smaller. Even if the underlying business is growing, the value of your individual share is being diluted away.
But Interactive Brokers operates with incredible discipline here. Adjusted for their recent stock split, the public Class A share count has only grown by about 2% per year over the last decade.
2% is nothing.
It's nothing. And almost all of that negligible increase is simply the mechanical conversion of internal employee shares as long-tenured staff slowly retire. They don't engage in massive dilutive M&A. They don't flood the market with secondary stock offerings.
Because their internal cash generation is so massive, fueled by those 77% margins, they fund their entire global expansion from their own balance sheet.
They don't need to tax the shareholders to grow.
Exactly. This is why their historical revenue growth has translated so efficiently into compounding shareholder returns.
Okay, so if we take all of these structural advantages, the margin profile, the 1% capex, the multi-billion-dollar interest engine, how do we evaluate this through the lens of the greatest capital allocators?
Let's apply the Peter Lynch framework first.
Okay, run it.
So Peter Lynch popularized the idea of investing in boring is beautiful businesses. He loved companies with unsexy names, operating in unglamorous industries, doing essential work out of the public eye.
Right, like garbage collection.
He famously loved garbage collection companies and industrial parts manufacturers because they quietly compounded capital without attracting massive competition.
Interactive Brokers is the ultimate digital tortoise. Order routing and API ledger integration is practically invisible plumbing. Thomas Peterfy doesn't go on tech podcasts or post inflammatory tweets to drive retail engagement.
No, he really doesn't.
They spend a fraction of what Robinhood spends on marketing. And despite this absolute lack of flash, their customer accounts have grown for 33 consecutive quarters. Customer equity has tripled in just 5 years.
Lynch would classify this as a fast grower, perfectly disguised as a slow-moving financial company.
Right.
If you run the PEG ratio, which takes the price-to-earnings multiple and divides it by the expected earnings growth rate, you get a very clear picture. Interactive Brokers trades at a forward PE of roughly 36.
Which, in isolation, sounds like a massive premium.
It does. But when you factor in expected EPS growth of 15 to 20% fueled by international retail expansion, the PEG ratio sits around 1.8 to 2.4.
Okay.
So it isn't a deep value cigar butt, but it is a remarkably reasonable price to pay for an asset compounding with this much certainty.
Okay, let's shift to the Warren Buffett and Pat Dorsey framework. How deep is the economic moat? Dorsey outlines 4 main sources of competitive advantage, and Interactive Brokers dominates 3 of them.
So we already established the cost advantage. Being the lowest cost producer in a commodity logistics business allows you to survive pricing wars that mathematically bankrupt your competitors.
Right. What about switching costs?
The switching costs for their core demographic are astronomical. Look, if you are a 22-year-old with $2,000 on Weibo, you can transfer your account to Robinhood on a Sunday afternoon with a few taps.
Very easy.
But if you are a $500 million quantitative hedge fund, your operations are fused to Interactive Brokers.
Yeah, that's a different story.
Your proprietary trading algorithms communicate directly with their matching engine via custom APIs. Your complex margin borrowing agreements are negotiated and formalized. Your back-office accounting, which spans 15 different global currencies, is reliant on their specific daily reporting structure.
It's deeply embedded.
Exactly. If that fund decides to switch time brokers, it isn't a weekend project. It is a multi-month, massively disruptive infrastructure migration that risks significant trading downtime. Consequently, the institutional churn rate is practically zero.
And the third moat source is intangibles, specifically regulatory capture. Interactive Brokers provides access to over 160 markets across 200 countries from a single unified account.
Which is insane.
You can buy Japanese equities, European bonds, and U.S. options seamlessly. To offer that, you need hundreds of distinct regulatory licenses from foreign central banks, financial ministries, and regulatory bodies. You have to park localized regulatory capital in dozens of jurisdictions.
Which sets up the ultimate theoretical stress test. We call it the $10 billion moat test.
I love this thought experiment.
If I handed a brilliant Silicon Valley engineering team $10 billion in venture capital and gave them 5 years, could they build a product to kill Interactive Brokers?
The definitive answer from our analysis is no, absolutely not.
But $10 billion is an incredible amount of resources. Why wouldn't it work?
Because capital only buys technology. It cannot buy time.
Right.
You can use that $10 billion to hire the best software engineers away from Google. You can buy the fastest fiber optic lines to the exchanges. You can design an award-winning user interface.
Yes.
But you absolutely cannot buy 40 years of institutional integration with 160 foreign governments. You cannot instantly acquire the operational trust required for a multi-billion-dollar family office to hand over custody of their assets.
It takes decades.
Robinhood proved this hypothesis in real time. They had billions in funding and unparalleled cultural momentum. They successfully captured the retail dopamine traders, but they entirely failed to dislodge the smart money that Interactive Brokers guards so fiercely.
That actually brings up a contradiction in how we value this moat, though. Yeah, because Buffett traditionally defines a great business by its pricing power. The ability of a company, like an Apple or See's Candies, to raise prices every single year without losing market share. Customers just accept the hike and pay up.
Right. Buffett loves that.
But Thomas Peterffy operates with the exact opposite philosophy. He uses his technological advantage to relentlessly lower prices, weaponizing his cost structure to suffocate competitors. Does that invalidate the Buffett moat framework?
It's a different philosophy, sure, but I argue it leads to the exact same outcome. Inevitability.
So.
What Peterffy executes is closer to the Costco model, which analysts call scale economics shared. Costco could easily raise the price of their hot dog combo or their Kirkland signature items and boost their margins for a few quarters.
They absolutely could.
But instead, they use their massive scale to drive supplier costs down, and they pass every single penny of those savings back to the consumer. This ensures that no competitor can ever undercut them on price. Peterffy does the exact same thing with trading infrastructure. He sacrifices short-term margin expansion to permanently guarantee his unassailable position. He makes competing with him mathematically ruinous.
It is a brilliant defensive posture. But as the skeptic here, I have to pivot us into the bear case.
Bring it on.
We just spent the last half hour building a portrait of an invincible compounding machine with 77% margins and an impenetrable moat.
We did.
But the market is currently assigning this company a 36x multiple. At that valuation, the market is pricing in structural perfection. And there are profound existential risks baked into this company that cannot be ignored. We have to talk about the corporate governance structure.
Okay, this goes back to the two entities we mentioned at the very beginning. Break down the ownership disparity between the public ticker and the private operating company.
Right. So when a retail investor buys shares of the public ticker IBKR, they're buying an equity stake in a holding company called IBG Inc. But that holding company only owns 26.3% of the actual underlying operating business, IBG LLC.
So who owns the other 3/4 of the entire global operation?
The remaining 73.7% is held by a private entity known as IBG Holdings. And IBG Holdings is overwhelmingly controlled by one man, Thomas Peterffy.
Wow.
When you calculate the economic flow-through, Peterffy personally controls between 67 and 72% of the massive economic engine we just spent an hour praising.
That's a huge concentration of wealth.
It is. But, more critically, through a dual-class share structure, utilizing supervoting Class B shares, Peterffy holds over 90% of the voting power.
Over 90%. So he wields absolute unilateral control over the entire publicly traded entity.
Unassailable control. He cannot be voted out by activist hedge funds. He cannot be forced to alter his capital allocation strategy by an independent board. The public shareholders who buy the stock are essentially just passengers strapped into the backseat of his car.
And he's driving.
They have zero hands on the steering wheel.
Okay, when you describe it like that, it instantly evokes the catastrophic failure of WeWork.
Exactly.
And the source materials draw that direct parallel. Adam Neumann, the founder of WeWork, structured his company with similar supervoting Class B and Class C shares. He gave himself the unilateral right to hire and fire the board of directors. He was completely immune to public shareholder oversight.
And we know exactly how he abused that power.
We really do.
Newman used his absolute control to lease commercial buildings that he personally owned back to WeWork at a premium.
The self-dealing.
He trademarked the word "we" and then forced his own company to purchase the rights from him for $5.9 million.
Unbelievable.
He burned through billions in capital, driving the private valuation to $47 billion while generating massive operational losses. And because of the voting structure, the public investors who read the S-1 prospectus realized they had absolutely no mechanism to stop him. When the fundamentals finally collapsed and the company marched toward bankruptcy, the outside shareholders were totally wiped out.
I understand the fear. I really do. But applying the WeWork narrative to interactive brokers ignores the reality of the founder. Thomas Petersfy is the anti-Adam Neumann.
Okay, defend the dictatorship structure then. Make the case.
It comes down to ultimate alignment. Look at the deep value investment community. Brian Lawrence, who runs Oak Cliff Capital, is widely respected for his concentrated, fundamental approach.
Very sharp guy.
According to our notes, Lawrence currently holds Interactive Brokers as roughly 28% of his entire fund's portfolio.
That's a massive position.
He maintains that massive concentration not in spite of Peter Peters' control, but because of it.
How so?
Peter Peters has 98% of his estimated $100 billion net worth tied up in this single operating company. He has a 40-year track record of hyper-disciplined, relentlessly profitable compounding. He isn't trademarking words or engaging in self-dealing real estate schemes. His singular maniacal focus is out-engineering legacy banks on pure latency and cost. For a long-term value investor, riding shotgun with a founder who has that much skin in the game is a feature, not a governance bug.
Okay, I will concede that up to this exact moment in history, Peter Fay has operated as a highly effective, benevolent dictator.
Thank you.
He built the machine, and he aligned his wealth with the public shareholders. But my rebuttal is grounded in inescapable biology.
Which is?
Thomas Peter Fay is 81 years old. A benevolent dictatorship is structurally only as stable as the dictator. Because of the concentrated voting control, succession becomes the single most massive, unpriced risk hanging over the stock.
Well, he did officially step back from the CEO role in 2019. The current CEO is Milan Galic, who is a 30-year veteran of the company's engineering side.
And Galic has run the day-to-day operations brilliantly, yes.
Yeah.
But Peter Fay remains the chairman. He still holds the super voting shares. He's still the ultimate strategic decider. The risk is what happens the day he is no longer at the helm. Whoever inherits that private holding stake, or whichever entity eventually purchases it, will inherit unilateral, uncheckable control over a critical piece of the global financial infrastructure.
Okay, that is a scary thought.
If the next person holding those keys decides to engage in reckless M&A or shifts the risk profile of the margin book, the public shareholders will be completely powerless to stop it. Buying the stock today means accepting that long-tail succession risk without a discount.
That is a deeply sobering reality. Let's move from governance to the macroeconomic risks, though. We praised the net interest income engine for generating $904 million in a single quarter.
We did.
But that engine is fundamentally tethered to the Federal Reserve.
It is highly sensitive to the federal policy.
We established that Interactive Brokers prints money by capturing the arbitrage spread on $169 billion in idle customer cash when the Treasury yield is at 5%.
Right. But that environment is not permanent. During the Q1 2026 earnings call, their CFO, Paul Brody, provided a specific sensitivity metric.
What was the number?
He stated that for every 25 basis point cut the Federal Reserve makes to the benchmark interest rate, Interactive Brokers loses approximately $82 million in annualized net interest income.
$82 million for a single quarter point cut.
Yes.
If inflation normalizes and the Fed embarks on a sustained easing cycle, say, dropping rates by a full 200 basis points over 18 months, Interactive Brokers would see hundreds of millions of dollars of pure high-margin profit evaporate from their income statement almost overnight.
Exactly. When the macro rate compresses, their operating margin compresses with it. That massive 77% pre-tax margin could easily slide back down to the 60s.
And when a company trading at 36 times earnings sees a structural decline in its highest margin revenue stream, the market reprices the stock violently.
Violently. And while we're discussing the balance sheet, we have to address the vulnerability in that $46 billion margin loan book.
We noted earlier that the margin book is highly over-collateralized. What is the systemic threat there?
The threat is the collateral itself. Those $86 billion in loans are secured by the equity portfolios of the borrowers. If the market goes up or stays flat, the loans are perfectly safe.
Right.
But what happens in a true unprecedented liquidity vacuum? What happens in a 1987-style flash crash where the broader market drops 20% in a matter of hours?
The value of the collateral back in the loans just evaporates instantly.
Exactly. Interactive Brokers mitigates this risk by using aggressive, automated liquidation algorithms.
The bots.
The bots. If a customer's portfolio value drops below the maintenance requirement, the system doesn't call them to ask for more cash.
No margin calls.
No margin calls. It immediately starts market selling their positions to cover the loan. They survived the 2008 financial crisis and the March 2020 COVID crash with negligible credit losses because those bots are ruthless.
So what's the issue?
Those bots rely on the assumption that there will be a buyer on the other side of the trade. In a true systemic flash crash, where bids disappear completely and stocks gap down in massive increments, the algorithms might not be able to liquidate the collateral fast enough to cover the principal.
Oh.
If that happens, Interactive Brokers is left holding the bag on billions of dollars of underwater debt. It is the nightmare tail risk for any prime broker.
Oh, wow. Okay, we have thoroughly dismantled the mechanics of this company. We've examined the logistics origins, the smart routing technology, the massive interest rate arbitrage engine, the unprecedented 77% margins, and the profound governance and macroeconomic risks.
We covered a lot of ground.
We did. Now, we have to synthesize this data and commit to a final position. I will go first, representing the analyst lens, and I'm concluding with absolute conviction on the bull side of the thesis.
Interesting. Make your final case. Why are you paying 36 times earnings for a company facing rate cuts?
Because I am looking at the macro-secular tailwinds that transcend short-term Fed cycles. Look, we are currently witnessing a massive, multi-decade wave of global financialization.
Okay.
Emerging markets are overhauling their pension systems. There is a massive rise in self-directed retirement accounts across Asia and Europe. Millions of newly wealthy international retail investors and emerging family offices desperately want access to U.S. equities, European bonds, and global derivatives.
That's true.
All of that capital requires an efficient pipe to flow through. Interactive Brokers has spent 40 years building the fastest, cheapest, most globally integrated pipe in existence. Their technological moat is completely unassailable by legacy competitors who are bogged down by tech debt.
Fair point.
Their 77% margins are structurally protected by their near-zero capital expenditure requirements. The interest rate cycle will fluctuate, yes, but the underlying compounding growth of their customer equity is an unstoppable force.
I respect the long-term vision, I really do.
Yeah.
But I will take the role of the skeptic, and I conclude with equal conviction on the bear side.
Let's hear the final rebuttal.
I do not dispute the engineering brilliance of the platform, but I argue that the current earnings profile is largely a mirage. The staggering profitability we are looking at is heavily inflated by a generational anomaly in interest rates.
The macro gift.
Yes, they are currently earning monopoly rents on idle customer cash. As central banks inevitably normalize rates to prevent recession, that massive net interest income engine is going to sputter and the margins will compress.
It's mathematically certain.
Furthermore, buying this stock today requires paying a 36x multiple. At 36x, you're not paying for a great business. You're paying for absolute unblemished perfection.
Right, no room for error.
If account growth slows by a mere 2%, or if global regulators decide to alter margin lending requirements, that multiple will compress violently, destroying shareholder value even if the underlying company remains profitable.
Yeah.
And overriding all of that financial modeling is the governance risk. Buying this stock requires a blind leap of faith that an 81-year-old billionaire's super voting control will seamlessly transition to a new entity without fundamentally altering the risk profile of the company. For a premium multiple, that is simply too much structural uncertainty to absorb.
It is a phenomenal, necessary debate. Dissecting a business this complex that sits entirely beneath the surface of the broader market, it really forces you to reevaluate how the financial world actually operates.
It does.
And it leaves me with one final, slightly provocative thought for you to mull over.
What is your takeaway?
We spend so much of our time in the financial media glorifying the brilliant investor, right? We put the hedge fund manager who picks the right tech stock on magazine covers. We celebrate the quantitative trader who times the market cycle perfectly.
We love a hero.
But as capital becomes increasingly borderless and as trillions of dollars fly between global exchanges at the speed of light, maybe the ultimate winner of the capitalist system isn't the smartest investor at all.
Who is it then?
Maybe the true winner is simply the engineer who built the plumbing, who sits quietly in the middle of the flow and extracts a tiny automated toll every single time the money moves.
It is the oldest rule in infrastructure. The plumber always gets paid, regardless of whether the water flowing through the pipes is hot or cold.
Exactly.
If you enjoyed today's analysis, make sure to follow the show on your favorite podcast app so you never miss an episode. As a reminder, this podcast is for informational and educational purposes only and does not provide financial, investment, or legal advice. Investing involves risk, and you should always do your own fundamental research and consult a qualified professional before making any financial decisions. Thanks for listening, and we'll see you next time.